You know that there's something very nice about markets that are going up and down all the time? That creates some buying opportunities. For some reason, the market gets into that turmoil of uncertainties and now investors get nervous, and what they do? They dump their shares. And what you can do as a smart investor? Well, you can pick them up because they're kind of like undervalued, right? Dividend growth investors, bonjour, my name is Mike Héroux and I'm the founder of Dividend Stocks Rock, and I also host this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And today we are going to talk about 4 of my favorite undervalued stocks at the moment in 2023. There's a lot of opportunities, to be honest, and today I'm doing a video on Canadian stocks, and next week is going to be my 4 favorite US stocks. So let's get started with number 1, TD Corporation. TD Bank got slammed hard in the, I'm scared there will be a bank run and the banking system is going to die, mostly due to Silicon Valley Bank and Signature Bank in the US, where those are like small regional banks having like their own problems. I've discussed that in a podcast in Moose Market, so if you want to know more about that, you can hit the link at the bottom and listen to the episode. But long story short, the market is scared about TD Bank and now stock price drop, and here's your opportunity. What I like the most about TD Bank is its diversification from Canada and in the US. So 1/3 of their business is in the US, and this is actually the reason why a lot of investors are so scared of what's happening, because they're thinking, well, if TD Bank is forced to do exactly what Signature and Silicon Valley Bank did, which is selling assets because their bonds value dropped so much with higher interest rate that they had no other choice but to find other source of capital and then selling assets at a loss, well, they're going to be kind of like squeezed, right? Well, it's not going to happen for Canadian banks because they're well managed. They're well managed because the federal government is the ultimate regulators telling them not to do this kind of thing. So they're well capitalized, they have like plenty of money sitting in their bank account, and yes, the bond situation is affecting them because obviously they have bonds in their portfolio and those bond value has dropped, but not enough to put them in danger. The other thing that is quite interesting for TD is they're not only doing like banking and loans, they're also doing wealth management, they're also doing insurances, they also are well implicated in capital markets, so they're well diversified. If you look at their dividend triangle, what you can see, well, obviously on the price, you can see that it dropped about $10 for some low 90s to low 80s right up front during those news. Now the stock is like hovering. My guess is a lot of investors are waiting for the next quarter to appear to finally realize that, oh my God, TD Bank is in a good position, and then eventually we could talk about growth. If you look at revenue and earnings are quite stable. Obviously they're a little bit on the dip. This year is going to be tougher. This is why it's a great opportunity. Why? Because with higher interest rate, all banks are increasing their provision for credit losses. You saw that in my previous reviews of bank. I do a quarterly review on this channel, so if you have not done that before, subscribe, and then you'll see that every quarter I talk about all the Canadian banks, so you'll know a little bit more about that. But when you look at how revenues are growing and how the dividend payment is increasing every single year, besides the small portion when regulators said you can't do that because of COVID, TD Bank has a very solid profile. Now, why do I say it's undervalued? Because I know valuation, and it's not my forte. I don't like to talk about valuation that much, but what I like to do is to look at the historical P/E ratio, so to know how the market values a stock. That is one. And the second thing is I can use the dividend discount model for a mature business paying a decent yield. It will also help me to find if there's a good opportunities here or not. But I'm not going to give you a target price, because between you and me, target price, they're all balloonies. Most analysts are wrong all the time, and I rather pick amazing businesses with strong dividend triangle no matter what the price is. However, when I see a stock like TD Bank, well, I'm thinking, well, maybe there's an opportunity on that because it's a stock I like, and on top of that, the price drop. So looking at the overall industry for the top 6 Canadian banks, as you can see, you have the PE ratio on top and the forward PE ratio on top at the bottom. TD Bank is not the cheapest, but not the most valued stock. Actually, it's right in the middle, right above the 2 bank that I don't really like, Canadian Imperial Bank, so CIBC and Scotiabank. So if I have to pick one, I would pick the third one, that is TD, that has a good PE ratio of like 10, forward PE ratio at 9. So the market is not telling you that they're super excited about TD right now, and this is probably a good reason to dive in. The other tools that I use is the dividend discount model. What you can see here on the screen is actually a screenshot of what we have for over 400 companies at DSR. So at Dividend Stocks Rock, we run those simulation for valuation. So you can see that we have the recent dividend annual payment, expected growth over the short term and long term. So for the first 10 years at 6%, going forward at 6%, it's pretty much like between 5 and 7%. That's pretty much what we have seen so far. And a discount rate at 9. Why did I use a discount rate at 9? Because TD has been around for several years. Like we're talking about like 100 of years, more than 100 years, I mean. And we're talking about a very solid business operating in an oligopoly. They're well secured, and this is why I don't request such a high valuation, such a high discount rate. Intrinsic value at $135. So definitely right now there's a huge deal. You can say, oh, I'm going to be a little bit more conservative and I'm going to increase my discount rate. So the discount rate is the rate of expected return you want when you invest. So imagine that you increase it to 10%, then you move up one number, so you're at 101.76. So if you buy it right now at the price of like roughly $80, you have a margin of safety. This is where you see the 20% discount. Margin of safety around 20% at $81. So overall, when you look at the business model, the reason why the market panic, which is not justified, and the PE ratio plus the DDM valuation, well, you're starting to get a little bit more confidence to pull the trigger, right? Hey guys, I'm doing a quick break to let you know that on May 18th, I'll be hosting a new webinar on how to handle volatility in your 40s when you're accumulating and you can seize opportunities, and also past 65 when you are retired and withdrawals can be greatly affected by your volatilities. Over the past 3 years, we run into so many different events that created uncertainties throughout our portfolio and our retirement plan. We got the COVID destroying our economy. We got higher inflation struggling consumer spending. We got higher interest rates pushing people to revise their budget. We got the war going on, and the debt ceiling for the United States is about to crack. So a lot of things are going on. You may want to sit on the sidelines, but then you're gonna miss a lot of opportunities if you are in the accumulation phase. We're going to help you find strategies to stay invested. And if you're retired, well, the withdrawals during those periods are crucial. They can hurt your portfolio, and we will provide you with strategies to actually make sure that your portfolio is protected, but you can still withdraw money from it. So the link is right there, dividendstocksrock.com/volatility. It's 100% free. Webinar will have a full replay, and do not miss it. We're going to provide you with a lot of free newsletters, a lot of free tools, stock lists, and so on. So I'm waiting for you on May 18th. dividendstocksrock.com/volatility. See you there. And now back to our show. So here's another one that I really like. Canadian Natural Resources, CNQ.TO. And obviously you're gonna say, but Mike, aren't you not the guy that doesn't really like energy stocks? And you are right, I don't like them. You know why I don't like them? I don't like them because their business model is completely dependent on commodity prices. Either it's oil, or either it's gas. But the thing is, that is super volatile. It goes up, it goes down, and it's only good for investors that are able to buy them at the bottom, rock that boat, go on that roller coaster, and then sell them when they're a higher point. But once you reach that high point, it's gonna drop again. We've seen that over and over and over and over, and I don't get the love those companies are getting from a dividend growth investor's perspective, obviously, because if you're good at in and outs or investing in cycles, well, definitely you can make a lot of money on energy stocks. So I'm not going to debate on that. That is the truth. But I also know a lot of investors that bought the dip in 2017, 2018, and they're still waiting to get their money back. So it's not always that easy. But for CNQ, the best asset that they can have is their large oil sand reserve. The thing is, they have so much reserve that they can just produce all the time, and then when the prices goes lower, they just use their reserve, and when it's go higher, they produce a maximum amount of oil and gas, and this is how they are able to sustain a solid dividend growth policy. Because if you look at the energy sector, you do not have many companies showing more than 5 years of dividend increase. It's pretty rare. CNQ is over 20 years, and this is their secret. Their secret is that large asset where they can produce, and they're pretty much making money as soon as the oil barrel is above 35 bucks. So right now we're way above that. We're more than double than that, actually, closer to like 75 to 85, depending on the day you watch this video. It goes crazy, but then again, it offers them a very good way to generate cash flow when it's the good time, and then they pay down debts and they strengthen their balance sheet every single time. So if you look at the dividend triangle, what I found interesting is while they were pretty much stable before the COVID, they jumped a little bit, but not that much compared to other exploring companies. And that's fine. I like that, because when I look at the revenue and the earnings going higher up and the dividend trend that has been accelerating big time, well, I kind of like this type of business model. It's a little bit more mature, not going to grow from 80 bucks to 160 bucks tomorrow morning, but I rather have a dividend that is stable through time, it pays a nice yield, and I have a robust company with a robust business model behind it. For the PE ratio graph here, I've started in 21. Why? Because in 2020 it was kind of like all over the place, obviously, because it created a big gap. But what you can see here is it used to trade at roughly at like 11, 12 times the earnings. Now we're down to 8.6. Kind of hard to figure. Like, obviously the oil boost is pretty much over. Some people are saying that the oil barrel is going to reach 100 bucks and it's going to stay there for a very long time, but those people were telling that last year as well, and they were saying, oh, wait before winter comes in, and when winters come in, boom, it's going to hit 100 bucks. Didn't happen during winter. Now they're going to tell you the same song, but about summertime with vacation. So maybe it's going to happen, maybe it's not, but at this point, at like under 10% the PE ratio, under PE ratio of 10, I think CNQ could be a pretty good deal. Then this time, if we look at the dividend discount model, we can see that we have pretty much the right valuation at 83 bucks. So it doesn't look like a screaming buy, but this time I've used a discount rate at 10% instead of 9%. Why? Because I consider the energy sector a little bit more volatile, so that's why I'm demanding a little bit more. You can see that the dividend growth rate for the short period of time right now, we're in a heavy cash flow mode, so probably going to be a little bit more generous, probably even more than 7%, but then I reduced it to 5% for the long-term rate. I don't think it's feasible for Canadian Natural Resources to continue to crank up the dividend like high single to double digit every time. So at 5%, we're still very conservative, but a combination, again, with a strong business model, a low PE ratio, and a okay valuation, that tells me that there's something to be made here for CNQ. So before we go to probably the best high risk, high reward idea I have for you today, I want to invite you to download the dividend rockstar list I created right in the description below. So you put down your email, you're going to receive an Excel spreadsheet, and that spreadsheet is going to be updated every single month. What's the rockstar list? The rockstar list is the basket of all the best stocks on the Canadian and US market. So you have this opportunity to use a filter that just go down already to the best companies showing a strong dividend triangle. So we only select companies that over the past 5 years were able to increase their revenue, increase their earnings per share, and increase their dividend. So you're already starting with a very solid base for your research, and companies like CNQ are going to pop up at the top of your list. So this is a great way in this uncertain times to get excited about a stock, to do your own research, and then press the buy trigger. Now moving on to, and I have to highlight that again, high risk, high reward. So don't just not think about the high reward, but consider the risk. Allied Properties REIT, AP.UN.TO. Allied Properties, 70% of their business model is all related to renting office space. Then you're gonna tell me, oh, Mike, office space, everybody now wants to work in their pajamas, right? Yeah, maybe, but maybe it's gonna end up. I mean, we've seen like Royal Bank, for example, like pretty much telling their employee, you better come back not in your pajama, but in your suit in your office, because at one point we want to see your face and we want to make sure that you are productive, because that's a big problem for a lot of employers right now. A lot of people, they are very happy to work from home, but sometimes they forget the work from home and they just continue with from home and they forget about working. So anyways, Allied Properties, well diversified, mostly in Montreal and Ontario and Toronto, a little bit in BC and Alberta, and they have those urban data center. They are selling them right now. On one side, it's kind of interesting because that was like the safe part of the business right now, but they're maybe thinking I'm selling an asset at a high price and I'm buying asset at a very low price, because right now, office space, not exactly trendy, right? So what I like about Allied Properties is that they have prime location and they have well-diversified tenants. So that helps them to ensure that they get their lease, they can increase the rent because they are in those prime location. Now the hiccup here is the occupation rate is at 89%, and this year alone, I think it's like 8 or 9% of all their leases are coming up to renewal. So we're going to have the real picture of what's going to happen next in the next 2, 3, 4 years with renewal rate with this year in 23. So if the occupation rate remains around like high 80s, close to 90%, then we're going to be good. If not, it's going to be quite a circus. If you look at the dividend triangle, obviously stock price completely crattered. That has been a rough ride. I didn't put the earnings per share, and I'm not going to discuss the PE ratio because for REITs it's completely useless. We do not use those metrics because of their tax structure. In terms of revenue, they took a hit. Now they're going back up. But what I found intriguing here is when you mix the fact that they have prime location, they seems very certain about their business because they're selling their data center to buy more offices, and they keep increasing their distribution, which is quite surprising, especially in 23. They said, you know what, we're gonna keep up like increase around like 2 to 3% every year, which is what you can expect from a REIT. That is like very basic increase, but it tells you that there's some confidence behind the business model, which I find quite interesting. If you use the valuation model, obviously you're gonna find something interesting here. So at 3% dividend increase going forever, at a 9% discount rate, you get a valuation of $30. If you're a little bit more demanding, you can ask for a valuation with a discount rate at 10%, and then you have a valuation of like $25.75, which would be pretty much on target with the current value. So interesting type of business, a little bit too risky for some, so you have to consider that. I want to highlight that again, not a buy or sell recommendation, but I would put it on my buy list if I would like to do a speculative play. Let's just put it that way. Now going to a business model that is a lot more stable, that has been known for all Canadians, and I said Canadian Tires. So Canadian Tires, well, they also have Sport Check, Marks, Atmosphere, L'Équipeur, a bunch of like brands in French. So Sport Expert, Sport Rousseau, Hockey Expert. So I challenge you to say those without an accent, but anyways, that was just for the fun part. What I love about Canadian Tire, their unique proposition on the retail market, because I'm not big on brick and mortar retailer, but it's actually the fact that they own most of their brands. It's actually part of their growth business model. So in 2016, they had 32% of of what they sell that was owned by Canadian Tire, went up to 39 in 21, and their goal is to go up to more than 45% by 2025. So what's the implication? Well, the implication is that they control the brand, they have the distribution network, and then they become kind of like Amazon proof, because you cannot buy MotoMaster or Mastercraft gears if you go on Amazon. You have to go on Canadian Tire. So either you go on their online website, or either you go on their website, but on the site, I mean. But in any case, you'll have to go there. They have iconic brands. They have a strong network of distribution. So whenever you buy online, you can pick up at the store. They use the similar business model that Walmart does to have like a strong online presence. And because they own their brands, they have full control of everything. For that reason, I think that Canadian Tire will continue to thrive. Even now we have a recession, it's going to be a little bit harder, but they are also accommodating customers with their loyalty program and their financial services, because now they have their credit card. That is a great way for them to continue boosting sales in the meantime. Obviously, it's also a risk side, because if they're a little bit too generous with their credit card, they may end up with a lot of provision for credit losses. So you have to follow that for Canadian Tire going forward. But overall, I really can see Canadian Tire being there and thriving in 5 years, 10 years, 15 years from now. If you look at the dividend triangle, you can see that it was relatively stable. They got up like a small drop. Now it's going back up. There's some momentum. The revenue and earnings are not that bad, and they have increased their dividend with a generous yield at now. So since 22, they have been quite generous in terms of dividend increases. I don't expect that to happen again, but it shows the level of confidence Canadian Tire can have. I mean, they're not slowing down their dividend growth policy, they're accelerating it. Management is telling you, we are doing good business. When you look at the PE ratio, well, I'd say that for a mature business, very stable, some growth perspective here, iconic brand, great distribution network across Canada, and you pay less than 11 times the earnings, that sounds like a pretty good deal, right? It's not amazing. You don't expect Canadian Tire to grow double digit either. So it's not a growth stock, but it's pretty much like a sleep well at night stock, where it's going to pay a good dividend and you're going to have some capital appreciation down the road. So it's a good mix between both if you're looking for a solid dividend grower in this sector. Finally, you have a pretty good summary here with the DDM valuation. It's pretty much on target right now. If you ask for a discount rate of 9% and you increase the dividend by 5% going forward, probably the next few years, it may be a little bit more generous, but I'd rather be on the conservative side. Again, I want to highlight that one more time. Those numbers are nice to see, they're nice to have, but it doesn't tell you what's going to happen in the next 12 months. So you do not buy a stock for its valuation. You buy a stock because you have to do your due diligence and you are convinced that going forward, it's going to be a great business, that it's going to thrive, and it has all the tools in their toolbox to make it happen. Most importantly, you focus on dividend growers. This is where you'll find companies that are able to go through recession, high inflation, high interest rate, or whatever the curveball the market's gonna throw at us in 25. Dividend growers are going to go through that because they have all of those factors. If you wanna see more ideas like that, if you want to get more ideas like that, download the Rockstar list, where you see only companies with a strong dividend triangle. And when we're talking about companies that are thriving, a healthy balance sheet, good margin, like a wide distribution network, iconic brands, well, those are all the great factors that you're looking as an investor. Well, if you're looking at a stock that shows a strong dividend triangle, you get all those factors packaged in, because it's impossible for a business to grow their revenue, grow their earnings, and grow their dividend if they have bad margin, they're losing market shares, they have a bad product, and they're on the verge of bankruptcy. It's impossible to have both. So just save your time, download the Rockstar list, the link in the description below, and start investing in companies with a high standard. So I hope that you have enjoyed this video. I'm curious about your thought about the most undervalued Canadian stock in the market. Next week, we're going to talk about the US one. So in the comments, let's get the discussion starts about that. And then next week, we're going to talk about US stocks. And don't forget to stay invested.